Apple's stock has been one of the most talked about investments of the decade. But as we head into 2026, is AAPL still worth buying? Today, we'll break down the company's current situation, the pros, the risks, and what I personally expect for the future. And of course, this is not financial advice. Apple, fiscal Q3. Revenue came in around $94 billion, up roughly 10% year-over-year, driven mainly by the services division iCloud, Apple Music, and the App Store. Right now, Apple trades at about $260 per share, with a market cap near $4 trillion and a PE ratio of around 40. That means investors are already paying for a lot of expected growth. Apple is no longer a small rocket ship. It's a mature tech giant with predictable earnings and a very stable business model. Now, let's talk about the positives. Apple's brand and ecosystem are unmatched. Once a customer joins, they rarely leave. Its services business keeps growing, bringing higher margins and recurring revenue. The company generates massive cash flow, keeps buying back its own shares, and pays consistent dividends. And it's heavily investing in artificial intelligence and integration across devices, from Apple Intelligence to new projects in augmented reality and health tech. But there are also reasons to be cautious. Apple is already so large that explosive growth becomes very difficult. Competition in smartphones and wearables keeps getting stronger, especially in Asia. It also faces risks related to tariffs, global supply chains, and political factors. And with the stock already valued highly, the room for big upside is smaller. If results disappoint, the stock could easily pull back. Here's what I see for 2026. In a base case, Apple continues to grow slowly but steadily, maybe 5 to 10% a year, with solid profit margins from services and consistent shareholder returns around 8 to 12% annually. In a bullish case, Apple surprises with a major breakthrough in AI or AR and enters a new growth phase. In a bearish case, the company faces slower sales, higher costs, or global pressure, leading to little or no stock appreciation. Overall, I see Apple as a safe compounder, not a higher-risk, higher-reward play. A few deeper insights. Apple is slowly transforming from a hardware company into a services powerhouse. As it moves part of its production to India and Vietnam, it reduces dependence on China and gains more stability for the long run. But the truth is that much of this optimism is already in the price. Unless Apple delivers something truly groundbreaking, returns are likely to remain solid, but not spectacular. If you want rapid growth, there might be better opportunities elsewhere. If you want stability, consistency, and one of the best-run companies in the world, Apple remains a strong long-term choice. So, should you buy Apple stock in 2026? It depends on your goals. If you're looking for safety, consistency, and reliable performance, Apple still makes sense. If you want huge upside, it may not be the right play. Always do your own research, diversify your portfolio, and remember, investing isn't about being perfect. It's about improving your odds. If you'd like me to analyze another stock next, leave it in the comments, and don't forget to subscribe.